Welcome to Stock Talk with Mike. I want to talk today about another beaten down growth stock, and that is Teladoc Health. It's trading at least a 50% discount from where it was at its all-time highs earlier this year. I want to talk about its current valuation, why investors are selling this stock, if it's a good investment right now, in my opinion, what I've done with my position size in Teladoc, what hedge funds are doing if they're buying or selling, what analysts think of the stock, and what I think's in store for Teladoc moving forward. So just getting right into it, let's look at the stock chart here. You can see the big sell-off from its highs back in February of where I think it hit an all-time high of $308 a share to where it trades now at $140.18. So ouch, there's definitely been a lot of pain in Teladoc, but I put up this 5-year chart to give a bit of perspective of how Teladoc has kind of behaved over the years, and it goes through these periods of big consolidation where it doesn't do much, and then it's done these big spikes. Even back in 2019 here, it was trading at $50, $60 a share in that range for the better part of the year, for several months, before just doing this parabolic run from $50 or $60 a share up to $200 a share by summer of 2020. And then it ran sideways for much of 2020, not doing much. But, if you got impatient and sold out, you missed out on some big upside, because right around the end of 2020, it did another parabolic run from $200 up to $308 a share. And unfortunately for investors, or at least short-term investors, that was short-lived, as it sold off hard down to where it currently sits at $140 a share, more than a 50% discount. So obviously, if you look at a long-term chart, the general trajectory has been definitely up to the right, but this has been an extremely volatile ride with massive spikes and some pretty big sell-offs, obviously, in Teladoc. So, price is kind of truth, and where it kind of sits is what the general market sentiment is around the company. But I also feel like the big moves up in some of these stocks are just as unjustified as some of these big sell-offs, obviously. And, the more realistic, accurate reflection of share price is probably somewhere in the middle. So Teladoc's kind of trying to find itself right now. It's consolidating. Meanwhile, I think it's important to look at the underlying fundamentals of the company and how it's performing. So we're going to look a little bit at that as well. So actually, I just want to dive into a little bit of their valuation. So currently their market cap is $21.59 billion. Definitely the largest true, pure telehealth, virtual healthcare play out there. There's a couple other smaller companies recently come public that got quite a bit of attention, but they definitely don't have anywhere near the scale or, to be honest, the growth that Teladoc has either. So if you look at their sales though, like the revenue has just been on an absolute tear. Even pre-pandemic, you look from 2016 here, they're $123 million in revenue. 2017, that doubled to roughly to 233 million. That jumped up to 418 million and up to 553 million in 2019. 2020, with the acquisition of Livongo, we saw a huge revenue spike. It was almost more of a merger, right? Livongo was almost the same size as Teladoc, right? So they're very similar sized companies. So that was a massive, that made them a much, much larger company. It was a massive acquisition. So revenue jumped from 553 to 1.09 billion. Also, I'm sure the pandemic was a driver in there as well. But this year, there's still expected massive growth from there, up to 2.01 billion. Actually, I'm going to show you a little snippet from their Q2. They actually upped their guidance again, even from there. Yet next year, expecting over $2.6 billion. And honestly, you look at these numbers. So they have sales currently of $2 billion, trading at a market cap around 22. They're currently trading around 10 times sales. And then next year's sales expected to have, again, massive growth. And I expect they'll beat these numbers. Analyst expectations, that's only 29% growth. And they've already upped their guidance for this year. So I wouldn't be surprised if next year they're pushing in on $3 billion of sales already. But anyways, even at this analyst estimates of $2.6 billion in sales next year, that's only 8 times next year's sales. So that's not cheap, but that's a very, very reasonable valuation for a company that is a software as a service company with reoccurring revenue. Looking at next year's sales, 2023 sales, so 2 years out, analysts are expecting 3.27 billion. And again, I think these numbers will actually surpass analyst expectations once again, but that would be about 6 times 2023 sales. So not bad. Software as a service companies. This is a chart showing the average valuation from a price to sales multiple for SaaS companies, so software as a service companies. And in 2020, that multiple was 16.6%. So Teladoc is trading at a steep discount to those valuations. And let's compare Teladoc to another pure healthcare telemedicine play that recently came public through a SPAC. And that's Amwell, which got a lot of attention when it first came public. And I feel like a lot of people were hyping this stock. I don't know if it's because it's smaller and people think then naturally it's going to have more growth runway ahead of it than Teladoc. But I didn't really understand that. Like Teladoc to me just seems like a much better play in the virtual healthcare space. So Teladoc, just a little side by side here, their market cap 22.3 billion versus Amwell just 2.3 billion. So 10 times larger of a company from a market cap perspective. As far as looking at this year's sales, price to sales ratio, Teladoc is trading around 10 to 11 times. Amwell's trading at 10 times, so maybe slightly cheaper, but around the same. But this is the kicker. So despite Teladoc having way higher revenues and being much, much larger company, like by a mile, their revenue growth this year is expected to be 86%. I think that's light. I think it'll be higher than that. Last quarter was 109%. Amwell is expecting 7% revenue growth. So a small company isn't even gaining market share and not growing very quickly. And the gross margins on Teladoc are 43% versus Amwell 37%. And I think Teladoc gets a bad rap for not being profitable, but their gross margins are very high. And that's what I think warrants this multiple, because it's going to give them a lot of levers towards profitability in the future. Right now, they're investing very heavily in marketing and development. And I think that's good as they're growing out their business. And you can see it's paying off as they're growing just exponentially. And they're still also paying off that Livongo merger, right? This was more of a merger than an acquisition. It was a massive, massive acquisition. And that's still showing up on the bottom line as well. Teladoc is also a top holding in Cathie Wood's ARK Invest funds. Their flagship fund, the ARK K Innovation Fund, Teladoc is actually their second largest position and has been for quite some time, only behind Tesla. So they have a 5.59% weighting in Teladoc. It's also in their ARK G Genomic Revolution Fund. It's actually their largest position in that fund with a 6.78% holding. And, worth mentioning, Michael Burry, who claimed to fame really was calling the financial crisis in 2008, has been a big bear against Tesla and has been public about his short on Tesla. And he sort of doubled down recently going short the ARK fund and ARK K fund. And he's kind of batted heads with Cathie Wood a little bit, where part of that short obviously is betting against companies like Teladoc. But I think Michael Burry's point is about the valuation of these companies. And Teladoc, I think with this big sell-off, yeah, it was getting frothy, it was getting up there. But I think it's not appreciated that it's more than just a pandemic play. And the valuation has really come in, is quite reasonable at under 10 times sales. And based on numbers projecting out, like around 6 times sales potentially even by next year. And those gross margins are really high on the business with that reoccurring revenue. I don't think it's getting credit for that. And I think, you've seen this sell-off and it shows up in the 13F filings too, as far as hedge funds holdings. In Q2, it was dropped from 855 funds holding it to 784, but percent institutional ownership currently is about 79%. So it is still very high institutional ownership in Teladoc. We had a number of funds close or reduce their positions, 133 close their positions, 268 reduced, but those that held, 320 increased their positions. So it seems to be very a polarizing company right now where you have funds sort of doubling down at these lower levels and also other funds completely exiting their position, just different investing strategies, obviously. And I think that there's a bit of disparity in the market right now around Teladoc, and that actually makes it really interesting and attractive, I think, at these levels moving forward. And I think people aren't appreciating that its valuation is actually quite reasonable. And that's what's going to happen when you have a company that is growing revenues at 100% clip. It's going to grow into that valuation. And I think that's kind of going under the radar. You see a lot of these other SaaS companies trading at 50 or 60 times, not even earnings, but sales. And then you have Teladoc here, whose valuation has continued to come in while they've been growing revenues at 100% clip, now trading at under 10 times sales, looking a lot more attractive, especially since they're expected to see that revenue runway continue. So looking at my holdings in Teladoc, I hold it in my growth portfolio. It's definitely a top 10 holding for me. I currently, let's see here. I first bought it actually back in February of 2018 at $34.90 a share. And that original position is up 301.66%. I actually had a lot more shares than that at that price, but as it went up in value, I did trim it back a little bit. And I've been buying back over time. I bought some more shares back in December of 2020 at 182 during a pullback. And then this year I've been buying at various increments as it's dropped down quite aggressively. I bought at 222, I bought 189, I bought it 169, and I bought more recently at 134 and $149 a share. Kind of around that $140 mark right now, I think is a very attractive buy in Teladoc. It's been a great performer for me since I've originally been in it in 2018, even with this sell-off. That initial position, like I said, still up over 300%. And again, I had a lot more shares than that, but I did some trimming at higher levels, and then been buying back to keep it properly allocated in my portfolio as we've had a bit of this sell-off. As far as analysts rating, currently analyst price target, there's 20 analysts covering Teladoc, 11 buys, 9 holds. But interesting, the average price target is $199.37, which represents a 42.22% upside. The highest end of the range as far as analyst price targets is 291. That's like well over a double from these levels. So very interesting. And the lowest on the street is 142. So basically at today's levels. So generally analysts are expecting a much higher price in Teladoc over the next 52 weeks. So again, I think this is a company that has been kind of thrown out with the bathwater as a high growth stock that is not an attractive valuation. Again, they're not profitable, but at the same time, been investing very heavily in their growth, have been acquiring companies, at a price, obviously, but they're growing incredibly fast and definitely by far the leader in a very disruptive industry. And I really like their prospects for the long term. So that's about all I have for you today. Thank you so much for watching. Happy investing.